options and their use and how to use them in hedging is that forward, right? If somebody does a forward in the market, right? For example, currently spot is 87.60 and let's say for 6 months the premium is 80 paisa. I'm just taking an example. So it is 85.50 is the forward rate for 6 months. Now, if I buy, right, forward for 6 months, right, I will get 85.50 rate. But what is the upfront cost I'm paying? Upfront premium or upfront cost, I would say, is equal to 0. I don't pay anything today. Whatever that is, this is the rate. 85.50 is my locked in rate. Today, which means to say that as per the current market, the forward is 0 cost. There is no cost to the forward today. Right? Why is this happening? Because this let's say 85.50, if spot on that day ends up above 80, you will keep gaining. However, how is the spot? How much is the spot above? That much will be your gain. And if the spot fixes below 85.80, you will start losing. This is your payoff at half maturity of a forward, right? The point is, standing today, this payoff can be equal. This is the gain part, potential gain, and this is the potential loss, right? Now, potential gain is basically depending, you don't know what the gain will be. Similarly, potential loss, you don't know what the loss will be. But standing as of today, the market is saying that you are potentially going to gain or losing. Both are possible with equal chance. And therefore, the expected value of that contract today is 0. If somebody says plus 100 with a 50% probability, right, and minus 100 with 50% probability, for example, over this contract, if this is my contract, how much is the value of this contract today? 0, because 50% chance. So expected value is simply 0. 50% into 100 plus minus 50% into 100. So again 0, right? So forward by definition therefore has both components, right, where you can gain, and an obligation where you can lose, right? A forward can be looked at as a part where you have a right to buy at 85.50 if spot is above 85.50. Similarly, you are obligated to buy at 85.50 if spot is below 85.50. So forward is a combination of right and obligation. That should actually give you a hint. Right means buying an option. Here in this example, buying call. Because buying a call gives you a right to buy. Right? So I have a right to buy above 85.50. This part, obligation, should give you a hint. Obligation means you are selling an option. Right? So this part you are buying an option. This part you are selling an option. Selling what? You have an obligation to buy. Which means you have taken on an obligation. You have sold an option to somebody and you have taken an obligation. So if you go back to that previous matrix that we have, you see here, obligation to buy comes from selling a put, right? Because that's the bottom line. So here you're selling a put therefore. So you can think like this, a forward contract or by any in general contract where you're locked in at a particular rate can be broken down as a right to buy. In this example, I'm talking about buy dollars. So you have a right, which is a buy option, and an obligation, which is a sell option. So buy call, sell put will lock you at a same strike rate of, in this example, 85.50, will lock you in at 85.50, right? So this is the critical link between forward and options. Forward is both right and an obligation, and hence potentially 0 cost if that, depending on the rate. If the forward rate is 85.50, then buying a call at 85.50, selling a put at 85.50, both equal, the same strike, will be 0 cost, right? Now, another point that you have to keep in mind is this, that because there is a forward, which is a right and an obligation, right? This is an obligation part and a right part. So buying forward is buying a call and selling a put. Now, imagine I want to only have this part. Which means what? The obligation part should not be there. That's what an option is, right? Plain option will be right, no obligation. Which means less than 85.50, I have no obligation, no gain, no loss. Above 85.50, I gain. Because of this part being not there, market will say 100 with a plus 50% probability. Earlier, there was minus 100 with plus 50, then 100 with loss with 50% probability. Then there was no cost or loss, right? There's 0 cost. But now there is 0 with a minus 50% chance, right? There's no loss. So obviously market will say this contract has a value, can't be free. And therefore an option by definition has a cost. Any option has a cost or value rather, right? That is called option premium. Option premium is always paid upfront today. That means you buy an option today, you will pay the premium in interbank market, you will pay the premium by day after tomorrow as cash.